Welcome to Chapter 6, Efficient Diversification. Diversification is often described as finance's closest thing to a free lunch, but even free lunch comes with terms and conditions. Owning more securities is not automatically the same as owning different risks. 12 funds can still hold many of the same mega-cap technology companies. 30 stocks can all depend on lower interest rates, strong consumer demand, or the same economic cycle. In that case, the portfolio has more ticker symbols, but not necessarily more protection. A zoo with 30 penguins is still not biodiversity. This chapter gives us the tools to look beneath the labels. We will separate market-wide risk from firm-specific risk. We will use covariance and correlation to describe how assets move together. We will build an investment opportunity set, identify the efficient frontier, and then combine the best risky portfolio with a risk-free asset through the capital allocation line. We will also connect the logic to the single index model, which separates market exposure from residual company-specific risk. The real-world lesson is important. In 2022, stocks and bonds both struggled because inflation and rising rates affected both sides of the traditional 60-40 portfolio. That did not prove diversification was useless. It showed that correlations can change when the economic regime changes. As we move through the chapter, keep asking one question. What risk driver does this position add, and how does that driver behave when the rest of the portfolio is under pressure? Diversification is not a head count, it is a relationship. This chapter has 4 practical learning objectives. First, you should be able to explain the difference between systematic risk and firm-specific risk. Systematic risk comes from broad forces such as recessions, inflation shocks, interest rate changes, and market-wide risk aversion. Firm-specific risk comes from events such as a product failure, accounting problem, lawsuit, or management mistake. Diversification can reduce the second category far more effectively than the first. Second, you should be able to calculate and interpret expected return and risk for a 2-asset portfolio. Expected return is a weighted average. Portfolio variance is not. Risk depends on the weights, the volatility of each asset, and the way the 2 returns move together. Third, you should be able to use covariance, correlation, the investment opportunity set, and the efficient frontier. These ideas turn a collection of assets into a risk-return menu. They help us identify portfolios that are dominated and portfolios that offer the highest expected return for a given level of risk. Fourth, you should be able to explain how the risk-free asset changes complete portfolio choice. Investors may agree on the same optimal risky portfolio, but choose different amounts of it based on risk tolerance. One investor may combine it with treasury bills. Another may borrow and hold more than 100% of the risky portfolio. The assessment focus is application and judgment. A strong answer will not simply say that lower correlation is better. It will explain why, identify the assumptions, and state what risk remains. Excel can optimize a bad assumption very quickly. The investor still has to supply the judgment. The chapter is organized around 4 connected questions. The first question is risk components. Which risks are shared across the market, and which risks belong to a particular company or security? The single index model gives us a useful framework. Part of a security's movement is related to the market, and part is residual. As the number of independent positions grows, much of the residual risk can wash out. The market component remains. The second question is correlation. Diversification works because returns do not move perfectly together. Correlation tells us the strength and direction of that relationship on a standardized scale from -1 to +1. Lower correlation generally creates more potential risk reduction, but the estimate is not carved in stone. The third question is the opportunity set. Once we vary portfolio weights, we create many possible combinations of expected return and standard deviation. Some combinations are clearly inferior. Others improve the trade-off. The fourth question is the efficient frontier. This is the upper edge of the opportunity set. The portfolios that offer the highest expected return for each level of risk at a risk-free asset, and the decision becomes a capital allocation problem. The sequence matters. Identify the risks, measure how they interact, build the menu, remove dominated choices, then select a complete portfolio that fits the investor. During calm markets, correlations may make the menu look wonderfully broad. During a crisis, many risky assets can suddenly respond to the same fear, funding pressure, or liquidity shock. The map is useful, but it is not a weather guarantee. This slide brings together 6 concepts that students should be able to define, calculate, and apply. Systematic risk is the portion of risk tied to broad market or economic forces. A recession can hurt many companies at once. An inflation shock can pressure both bond prices and long-duration growth stocks. This risk cannot be eliminated simply by adding more securities from the same market. Non-systematic risk is specific to a company, industry, or individual security. A failed drug trial, a factory fire, or an accounting scandal may be devastating to one stock, but largely irrelevant to the rest of a broad portfolio. And this is the risk diversification can reduce. Covariance describes whether 2 returns tend to move above or below their averages together. Its units are return squared, which makes it useful in formulas, but awkward to interpret by itself. Correlation standardizes that relationship from -1 to +1. +1 means perfect co-movement. 0 means no linear relationship. -1 means perfect opposite movement, the theoretical diversification dream that is rarely delivered on demand. The efficient frontier contains the best available risky portfolios for each volatility level. The capital allocation line then combines a chosen risky portfolio with a risk-free asset. A practical example of poor diversification is an employee whose salary, retirement account, and company stock all depend on the same employer. That is 3 financial relationships, but 1 economic basket. When the company fails, the paycheck and portfolio can fall together. Diversification is supposed to prevent that kind of synchronized bad day. A disciplined diversification process has 6 stages. Step 1 is to list the eligible assets. The universe should reflect the investor's mandate, liquidity needs, taxes, account type, and practical access. A theoretically attractive asset is not useful if the investor cannot hold it, understand it, or exit it. Step 2 is to estimate the inputs. We need expected returns, variances, covariances, and correlations. This is where most of the uncertainty enters. Historical data provide evidence, but expected returns are especially difficult to estimate. Small input changes can produce surprisingly large changes in an optimized portfolio. Step 3 is to combine the assets at different weights. Expected return changes in a straight line with the weights. Portfolio risk bends because covariance enters the calculation. Step 4 is to filter out dominated portfolios. If one portfolio offers less expected return and more risk than another, it does not belong on the efficient frontier. Step 5 is to choose the optimal risky portfolio and combine it with the risk-free asset. The best risky mix is the one with the strongest reward to volatility trade-off under the assumptions. The investor's risk tolerance then determines how much of that portfolio to hold. Step 6 is to monitor and rebalance. Weights drift, correlations change, new data arrive. A 60-40 portfolio can become 68-32 after a large equity rally, quietly changing the risk budget. An optimizer is a very obedient intern. It will implement whatever assumptions we provide, including absurd ones, with impressive precision. Process discipline means testing the inputs, constraining the result, and asking whether the output makes economic sense before money is committed. The key relationship in this chapter is that portfolio variance depends on weights, individual variances, and covariance. It is not simply the average of 2 standalone volatilities. The math is not that polite. For a 2-asset portfolio, expected return is straightforward. Multiply each asset's expected return by its portfolio weight and add the results. Risk is different. The variance includes the first weight squared times the first variance plus the second weight squared times the second variance plus 2 times both weights times the covariance between the assets. That covariance term is the diversification engine. If the assets tend to rise and fall together, covariance is positive and risk reduction is limited. If their relationship is weak, the portfolio may be less volatile than either a simple average would suggest. If the relationship is negative, one asset can offset part of the other's movement. Correlation converts covariance into a more intuitive scale. The relationship can also be written as covariance divided by the product of the 2 standard deviations. But remember that correlation is an estimate from a particular sample and regime. A 5-year estimate can conceal very different behavior during inflation, recession, or a liquidity crisis. The risk-free asset changes total portfolio risk in a different way. Under the separation property, it scales exposure to the optimal risky portfolio rather than changing the internal risky mix. A cautious investor lends at the risk-free rate and holds less of the risky portfolio. A more aggressive investor may borrow and lever the same mix. Before using the formula, explain the direction. Higher weights increase contribution. Higher volatility increases risk. Lower correlation generally improves diversification. The formula should confirm the reasoning, not replace it. This comparison is one of the most important in the chapter. More holdings versus better diversification. More holdings can reduce exposure to a single company. That is useful. But the portfolio may still be concentrated in the same sector, factor, country, currency, or economic scenario. An investor can own a cloud computing fund, a semiconductor fund, an artificial intelligence fund, and a technology index fund, then discover that the top holdings overlap heavily. The account has 4 tickers and perhaps 1 dominant trade. Better diversification looks through the securities to the underlying risk drivers. It asks whether the portfolio depends on economic growth, inflation, interest rates, credit conditions, commodity prices, or investor sentiment. It combines exposures whose return patterns are imperfectly correlated and whose failure modes are not identical. The 2022 decline in many high-growth stocks is a useful illustration. Companies in different industries fell together because higher discount rates reduced the present value of distant expected cash flows. The names were different. The duration-like factor was shared. More holdings can also create a monitoring problem. Every additional fund, manager, or security requires due diligence, tax awareness, and rebalancing. At some point, diversification can become what Peter Lynch famously called diversification, adding complexity without improving the portfolio. A better review uses look-through analysis. Examine sector weights, top holdings, beta, duration, credit exposure, currency, and factor sensitivity. Ask what each position contributes when the existing portfolio is struggling. The goal is not the maximum number of positions. It is the minimum amount of unnecessary concentration for the investor's objective. Counting tickers is easy. Counting independent risk drivers is the real work. Diversification theory is embedded in many modern investment products. Index funds spread exposure across a market. Target date funds combine asset classes and gradually change the mix over time. Robo-advisors automate portfolio selection, tax management, and rebalancing. Technology has made implementation cheaper and easier. It has not repealed covariance. Consider what changed. Small investors can now own global portfolios with fractional shares, low fees, and automatic deposits. Rebalancing that once required a spreadsheet, and several trades can happen behind the scenes. Portfolio analytics can reveal overlap and factor exposure almost instantly. What stayed the same? Expected returns remain uncertain, correlations remain unstable. The efficient frontier still depends on estimated inputs. A beautifully designed app can rebalance in milliseconds, but it cannot negotiate with a new correlation regime. Who benefits? Investors who need simple, discipline, diversified exposure can benefit greatly. Automatic systems can reduce inertia and prevent one winning asset from quietly taking over the portfolio. What risk remains? Common holdings can create hidden concentration. Target date funds with the same retirement year can use different glide paths and risk levels. In March 2020, many risky assets sold off together as investors demanded liquidity. In 2022, both stocks and high-quality bonds declined as inflation and interest rates rose. Those episodes remind us that correlations often change when protection is most desired. The modern question is not whether diversification still works. It is whether the portfolio is diversified across the risks that matter in the current environment. Technology improves the machinery. The economic logic still determines the result. Let's apply the chapter to the practice case. The portfolio currently holds only a technology stock fund. The investor can add either a bond fund or a second technology fund. The bond fund is more likely to provide meaningful diversification because its return drivers may differ from those of the technology fund. Bond returns depend on interest rates, yield curve changes, credit spreads, income, and duration. Technology stocks depend heavily on earnings expectations, valuations, growth, and discount rates. If the historical and forward-looking correlation between the two funds is lower than the correlation between two technology funds, the bond fund can reduce portfolio volatility. The second technology fund may reduce manager-specific or single stock risk, but it could still own many of the same companies and share the same growth, valuation, and interest rate exposure. The ticker count would rise from 1 to 2, while the risk driver count might stay close to 1. Correlation is the key evidence, but it should not be used mechanically. We would want to review holdings, duration, credit quality, expense ratios, and correlations across multiple regimes. In 2022, rising rates hurt both long-duration technology stocks and many bond funds. The bond fund still may improve the long-run opportunity set, but it does not guarantee protection every year. One risk that remains is broad market or macroeconomic risk. Inflation, recession, or a liquidity shock can affect both assets. In efficient frontier terms, the bond fund may move the opportunity set to the left, providing lower volatility for a given expected return, or upward, providing more expected return for a given risk. The recommendation is bond fund subject to the evidence. Now pause and explain what fact would make you choose differently. Let's review 5 common mistakes. Mistake 1 is counting tickers instead of risk drivers. A portfolio can look busy and still depend on one sector, one factor, or one economic outcome. Look through the wrappers. Mistake 2 is assuming diversification eliminates market losses. It does not. Diversification is most effective against firm-specific risk. A recession, inflation shock, or panic can affect many holdings at the same time. Mistake 3 is using stale correlations as if they were physical constants. Correlations are sample estimates. They can change with monetary policy, inflation, liquidity, and investor behavior. A portfolio that looked balanced during a low inflation decade may behave differently when inflation becomes the dominant shock. Mistake 4 is ignoring the risk-free asset. Portfolio theory separates the choice of the best risky portfolio from the investor's final risk level. Cash or treasury bills are not merely leftovers. They are part of the complete portfolio decision. Mistake 5 is treating the efficient frontier as a guaranteed outcome. The frontier is drawn from expected returns, volatilities, and correlations that may be wrong. A precise curve can create false confidence. An efficient frontier built from historical inputs is a forecast wearing a geometry costume. The remedy is to stress test, use alternative expected returns, raise correlations during a year in crisis scenarios, examine concentration by sector and factor, set sensible weight limits, consider taxes, trading cost, and liquidity, then ask whether the result is robust enough to survive reasonable estimation error. The easiest diversification errors come from skipping assumptions. The model is not wrong because reality changes. The mistake is forgetting that the model was conditional in the first place. Here is the knowledge check. Which risk can be reduced substantially through diversification? The correct answer is A, firm-specific risk. Firm-specific risk comes from events that affect one company or a narrow group of companies. Examples include a failed product launch, a factory accident, an accounting restatement, a key executive departure, or an unexpected lawsuit. When a portfolio owns many securities whose company-specific surprises are not perfectly related, positive and negative outcomes can partially offset one another. Choice B, market-wide recession risk, is systematic. A recession can reduce earnings, increase defaults, and lower risk appetite across many securities at once. Choice C, inflation risk, affecting all assets, is also broad. Different assets may respond differently, but inflation can influence interest rates, profit margins, valuation multiples, and purchasing power throughout the portfolio. Choice D, an unexpected broad interest rate shift, is another systematic force. Rates affect bond prices directly and can also change equity valuations, financing costs, currencies, and real estate values. The single index model expresses the same distinction. A securities return can be separated into a market-related component and a residual component. As the portfolio adds independent securities, much of the residual variance declines, the market component remains. So the answer is firm-specific risk. Diversification can help when one company has a bad day. It is less impressive when the entire economy decides to participate. Let's close with 3 takeaways. First, diversification is about co-movement, not quantity. The number of positions matters only because it may reduce dependence on individual outcomes. The deeper question is whether the positions respond to different economic drivers. Second, the efficient frontier removes dominated choices. It identifies the portfolios that offer the best expected return for each level of risk under the assumptions. It does not tell us that the estimates are correct, and it does not guarantee that the selected portfolio will be efficient after the fact. Third, the complete portfolio combines risky assets with the investor's allocation to a risk-free asset. The optimal risky mix and the investor's risk tolerance are related decisions, but they are not the same decision. After the slides, the Canvas homework asks you to analyze a 2-asset diversification case. The discussion asks whether diversification makes investing safe. The quiz checks the core concepts and calculations. This chapter also sets up Chapter 7 on the capital asset pricing model and arbitrage pricing theory. Once firm-specific risk can be diversified, the next question is which risks the market should reward. CAPM answers that question with beta and systematic risk. In other words, Chapter 6 tells us which risk can disappear. Chapter 7 asks which remaining risk should be priced. Finish with the most useful question in portfolio management. What evidence would change my recommendation? If the answer is nothing, that is not conviction. That is a warning label.